Good morning and welcome to a live edition of the Monday Call. In this week's call, we're joined by Mark Brooks, CIO of NZ Funds, and we're going to take a deep dive into the inflation category. So that might sound like a really dull way to start the week, but it's actually incredibly important. So as a bit of an intro, New Zealand Funds uniquely offers a dedicated category specifically designed to fight inflation. These assets have the potential to grow earnings at a pace faster than inflation, and perhaps more importantly, preserve and even increase your purchasing power over time. And the reason these are so important is inflation might not seem like an everyday threat, but over time it can significantly impact your financial well-being. As prices rise steadily, the value of your savings and income can diminish, making it more challenging to save, spend, and plan for the future. So, Mark, not trying to make it sound more exciting than it is, but it actually is a really, really dangerous aspect of financial markets. And so I guess having a specific category to fight it is something that we're really, really proud of, and it's been part of our portfolios for a long time. But should we set the scene first? Do you want to take us through where we are with inflation, what's happening out there in the market, and then we can talk about specifically what we do?
Perfect. Morning, everyone. As you said, James, it's really about that issue of time, ultimately. And if we look at inflation, there's plenty of headlines at present with things like butter prices, etc. And we've been through a period of elevated inflation over the last couple of years. But I think if we look at it now, inflation here and now is not enormously high at 2.7% was the sort of last annual reading. But the key there is, over short periods of time, even when inflation is high, it's not necessarily a problem. Your problem becomes more when you look at a longer term time frame, 3, but probably 5 to 10-year time frames. And that's where it can actually become a material issue for people in terms of making sure that basically $100 is still $100 worth of spending. If we look back, and obviously we've been through a period of heightened inflation since COVID, but if we look at that, if we look back to since the end of 2019, New Zealand's CPI is up 24% cumulatively over that period. So that is it's a material impact on your $100 still being able to sort of provide $100 worth of spending. So I suppose, from that, that's why we have the inflation category. And in terms of how we approach it, we have a dedicated category, but 2, we actually approach it quite differently to others. And I think, and really this is what this presentation is about, is a couple of years ago, we went back and said, well, how do we actually think what is the best way for us to at least mitigate that impact of inflation? And ultimately, a lot of it comes down to the types of assets you hold. We're strongly of the view. And your traditional, in inverted commas, portfolio that's sort of aimed, institutional style portfolio that would be aimed to mitigate the impact of inflation would be something like a balanced fund, which is what they call sort of 60-40. So a mix of income assets, bonds and cash and shares. We actually take a different view and think that you're actually better positioned to be in a series of defensive shares, much more heavily weighted shares. One, because those defensive shares are quite naturally, they have some natural inflation hedges, and B, actually the New Zealand tax rules are very important once you get over that 5 or 10 year time frame.
So when we think about inflation, and you talked about the cumulative inflation that New Zealanders have experienced, I know it's highly politicized, even at the National Party conference over the weekend, talking about the amount of inflation that we got and therefore cost of living, and that's a huge political minefield for both parties. But what are central banks? I guess the difficulty with New Zealand and US, UK, Europe is we've got these annoying independent central banks who are in charge
which
of
are a good thing, ultimately.
Absolutely a good thing, and except if you're perhaps the orange guy in America who thinks that's not quite a good thing because he's not doing what they ask. But what are they doing, and we've had rate cuts because inflation has come down. No, prices haven't come down, just
Yes.
inflation has slowed. But where are we at the moment? US, perhaps New Zealand, and other countries.
Well, I think, first point is that, we had certainly across the Western world quite synchronized inflation sort of post COVID. And that was really a reflection of, there was a lot of money. Basically, governments did pump a lot of money into the system and people were chasing a relatively limited number of goods. So you saw inflation increase pretty rapidly. However, it's been quite asymmetric as generally inflation's come down around the Western world from those sort of, 6, 7, even I think case of Europe, sort of 11% as a peak, back down to that 2 to 3 type number. In some cases a bit lower. And really that's a reflection that the work by the central banks to raise short-term interest rates, to restrict, or basically make cost of living a bit harder, has actually worked. I think generally the inflation trend, despite some of the headlines, continues to be moving lower. The US is possibly a slightly different issue in the sense that they do have the tariffs. But tariffs, I think, are, it will be something which we need to wait and find out. But tariffs should be much like a change in GST. If GST changes, you do see that the inflation rate will jump up. But effectively, it's a one-time jump, and then it doesn't have a flow-on effect to continuing inflation. Tariffs, to a degree, create that one-time jump in pricing. Whether you see a follow-on is unknown, but we'll
I
see.
guess that's the fight, isn't it?
Yeah,
There's some central bankers in the US. I think it was Governor Waller, is it, who voted against holding rates and wanted to cut them just last week. But was he talking about the fact that actually tariffs are a one-off and the underlying inflation is weaker than people think and we should be cutting rates?
Yeah, exactly. And remember, they have a dual mandate of both maintaining inflation and maintaining full employment. And you did see some pretty weak employment numbers in the US on Friday. So from that point, they're trying to balance those two factors. Here, the Reserve Bank did pause last month. Expectation is that they do cut interest rates on the 20th of August at their next meeting. I think, there has been recently inflation has popped up a little bit. We're at 2.7. My view is actually a lot of that is kind of temporary, and there's actually, given the economy's remained very slow and large parts of the inflation number are pretty weak, things like rental and housing, which is sort of 40% of the inflation number, are really not going anywhere. But actually you do see that inflation number continue to roll back, and actually we can see more interest rate cuts in New Zealand. And I think that would be really positive for the urban economy. Clearly, rural New Zealand is very happy with what's happening across most commodity markets, but it's the urban economy that actually probably would do with some further interest rate
I think it was a
relief.
Tractor sales came out this morning was
I didn't see that.
is incredibly strong. I think it made headline news on the 6 a.m. bulletin. But it's certainly that urban economy. So I guess that begs the question mark: if inflation is starting to roll back, why do we need the category? And I guess it's because you just don't know where inflation is going to come from, especially for New Zealand, where most of our things are imported, especially things like oil and energy and those sorts of things. Is that the key risk for a country like New Zealand?
It is, but also remember, by the nature of the way in which inflation hits, it is very hard to find assets that respond instantaneously to inflation. So, to a degree, it's about having assets that continue to over time manage to keep up with inflation or do better than inflation. And a number of the positions in the portfolios, clients have sort of said, well, I thought this was an inflation portfolio. It didn't necessarily keep up during some of the heady days of inflation. What you're actually seeing now is catch up. There's often businesses, say like utilities is a good example. People have been, it's been concern about electricity prices rising. Well, actually, to a degree, that's an inflation catch up from earlier. as a lot of those companies start to roll through some of the um, price increases on the back of the inflation they've already seen. So it's a chance for those companies to play catch up, and ultimately the portfolios that own them to also sort of reap some of those positive gains.
Because I think we use the rule of 72 a lot. If you get a return, how long does it take to double your wealth? And you can do that with the inflation rate. And even at 3%, which is within the target,
Yeah,
if you do 3% inflation every year, then you're going to double the price of things
every
in
20,
20
30
years
years.
or
Yeah,
something.
yeah.
And so you need something to fight that, because everything's doubled in 20 years. And if you're trying to save for retirement and your retirement is 40 years away and you're sitting in cash, or even 20 years away and you're sitting in cash, you're having a real loss of purchasing power.
Yeah, and I think that's really the issue is, as I said at the start, inflation here and now gets a lot of airtime at different points. Butter prices are up, electricity prices, insurance costs, etc. But not a lot of discussion happens over what happens over a decade, what happens over that time frame, and that's the time frame people need to have. Is sort of, you're not really thinking weeks or months or years. It's actually thinking, well, I think years and decades ultimately, because that's where that impact is, even if inflation is relatively low. And that's, again, it's probably a little bit of a jump ahead, but that's ultimately a segue as to, why sitting in cash is a challenge, because, what is New Zealand cash done? Broadly about 4% is the average level over time. And, that's a fully taxed asset. So by the time, even if you're on a relatively low tax rate, still, at best, you're going to come out with you're going to stay equal to average inflation at best. More likely, if you're on a higher tax rate or inflation's a little bit higher, you're not going to
Keep it.
achieve that.
So how do you want to play things from here, Mark? That's the sort of setting the scene of why inflation can be detrimental. We've got some slides that we sent out in the email on Friday, but
Yeah.
we won't touch on them too much. But they're a bit of an aid memoir. So should I bring those up?
Yeah, may as well. I think the first one is sort of where are we different, I think is worthwhile talking about. And ultimately, that's about the mix of the assets. And yeah, this is probably a useful one, or actually maybe we go back one in terms of, what does make us different is we're very much focused on defensive growth assets. And in that sense, shares across three different sectors: property, infrastructure, and utilities, both New Zealand and globally. And as I sort of touched on before, it's really about having assets that, I use the word catch up, but in another sense, really having assets that have an ability to grow their earnings at or above inflation over time. And one of the nice things about having shares ultimately is, they are, maybe it gets a little nuanced, but they are a nominal asset. So, if inflation is higher, companies sort of by default will end up, their earnings will increase, even if they're not specifically inflation sensitive. Whereas something like your term deposit or a bond, that is a fixed return. It doesn't change with inflation. So really having assets that have that ability to grow earnings, and also having being defensive growth, have assets that have stable earnings and an ability to actually translate those stable earnings into a very high dividend income stream. That's really important, especially from the tax aspect for New Zealand, which we can get to at the moment in a minute. But if we look at different assets, I'm not sure if people can see this on the screen, but for those who might be listening, if we look at something like the S&P 500, of that, about, well, certainly a lot more than 2/3, just under 80% of that return from the S&P is capital return, a very small part from dividends, sort of circa 20-23%. Whereas, if you look at the types of assets that we have in the inflation portfolios, property, infrastructure, and utilities, generally the dividend from those is somewhere, I suppose, at a minimum. In New Zealand infrastructure, it's been in the 50% region. And at a maximum in the property sector, it's been sort of about 95% of the return. So, again, predictable, stable, again, maybe jumping ahead, but in New Zealand's case, yeah, New Zealand shares are not really taxed because you have the ability to have imputation credits from the underlying companies. If they pay tax, that tax payment gets passed to you in the form of imputation credits. And really, the percentage which they pay tax kind of comes down to, or the percent of imputation credits kind of comes down to how stable are their earnings. And if a company has very reliable, stable earnings, they'll often pay a very similar level of tax each year. So they will have a high degree of imputation credits there.
And I guess the key point around higher dividends is dividends generally increase, as you were saying, as companies' earnings increase with inflation. So you're at least going to get an increase in dividend at the same rate, if not better than inflation, because these companies are generating earnings.
Yeah, exactly. So from that point, it's about sort of having those assets which do increase in value. And that does mean that, if we look at something like this chart, where we look at, again, what is the probability of these assets, if we look back through time, beating or being ahead of inflation, being able to sort of mitigate the impact of inflation relative to, say, term deposits or cash investments. The longer you go through time, again, because your starting point with cash is about 4%, then you pay tax, is having assets that, one, have an ability to grow with time and grow in a stable but a faster manner, and certainly are able to capture a tax wedge, really does, the longer you go through time, build your ability to stay ahead of inflation over that 5 or 10-year period, which is the important part.
So that's amazing. So this chart, you're basically saying over a 10-year period, inflation equities, which are in the inflation category that we're talking about, will always beat inflation.
Yeah.
Have always beaten in the
last over the time frame we've got here, which is
absolutely.
back to I think 2006 to May last year. So a period which we've seen relatively high inflation. Will it always beat? Yeah, there's always never want to say always, but it'll, as the 7-year number says there, 97% of the time. Yeah, certainly it will create a high probability that you at least keep up with inflation, and that's ultimately the goal there, right?
Because what's really interesting about that time series, 2006 to May 24, is
You've had a bit of everything.
we've had a bit of everything. We've had incredibly high inflation, but we've also had central banks putting rates to almost zero, and this was pre-COVID.
Yep.
Because there was just no inflation, and we've had the global financial crisis. We've had a lot of COVID. We've had a lot of stuff, and really the evidence suggests that inflation comes and goes, but the inflation equities one outperform cash, but
Yep.
that's why we're all here, but also outperform inflation over a with a high percentage.
Yeah, and look, I think, again, it's a bit of a tangent, but if we come back to some fairly simple concepts, if we think about how have many New Zealanders made money over time, it's often been through property. What have they implicitly done by buying property and making that return? Is that they've made two choices. One, they've moved out of cash, out of that sort of 4% asset into an asset which is generating a higher return, sort of 7% per annum, and they've held it for very long periods of time. So from that point of view, really that's the ultimately the aim of the inflation area. Not necessarily looking to explicitly grow capital, but just make sure that capital can grow enough in order to keep up with inflation. So moving out of cash into a group of assets that we think are structurally, both from the type of sectors they're in, but also the tax regime that they're in, have an ability to keep up with inflation over long periods of time, over 5, 7, and 10 years. That's not long, that's medium term, but and certainly over the long term would more than stay ahead of inflation.
I guess the important thing is to remember that all the inflation category, you mentioned property, but these are all listed companies as well, so the liquidity remains. And this isn't buying uh, property developments in Mount Wellington, Auckland, and hoping we'll be able to sell them later on. These are listed companies, both domestic and global, in inflation equity type companies where we can be nimble and move and change, and be highly diversified, not just in residential or commercial property, but across a big spectrum of types of companies.
Yeah, look, I think it's a point we generally probably don't put enough emphasis on, but in terms of the portfolios, by definition, they're always very highly diversified. So, yeah, here we have three sectors, six different portfolios across New Zealand and global. So, yeah, some of those portfolios have up to 20 names. Others, just because the sector's a bit tighter, might be down to sort of 5 or 6 names. But again, it does mean clients have you know, north of 50 names in their portfolio. So it means they are very diversified. They're all listed. So, yeah, those sort of, there'll be volatility by the nature of them being shares, but yeah, you're not making a bet that this one developer has an ability to pay you back. So that's important. But I think, that's something that is quite important, but probably slightly unspoken within the defensive space is if we look at the different sectors, even though New Zealand and global sector might be the same, actually the assets in there can be quite different, and the regime and the demand supply environment they have might be very different. A good example might be if you look at another sector such as banks, financials. If you go back through the last 15 years, actually the performance of European banks and Australian banks looks very similar. Why is that? Broadly because global capital requirements, capital rules that banks live by are a global standard. And broadly, interest rates, give or take, are often quite global. So, the drivers of those businesses are quite uniform. So if you own a bank in France or one in Australia, actually the returns are not markedly different. However, if you look at something like utilities, the drivers of utilities in New Zealand, weather, demand, etc., will be very different to the drivers of utilities on the east coast of Australia, or even on the west coast of Australia, or in Europe, or east coast of the US. They'll all have quite different demand supply dynamics and quite different regulatory regimes. So, despite being in the same sector, you're actually getting a lot of diversity across the different assets.
And it's the same with, even the more, I guess, simple sectors like property that everybody understands. If you had a commercial property in San Francisco, you'd be really licking your wounds at the moment.
Correct.
Versus if you had one in I don't know, Sydney, you're probably faring a lot better, and hence the diversity even in those sectors.
Yeah.
So should we go through quickly each of the sectors should we and just introduce each one?
Yeah, I think we can do that. Probably don't need to go through in great detail. I suppose, one of the key parts we wanted to talk about the inflation sector at the moment is about 2 years ago, we went through a process of sitting down and saying, where do we really think, what do we think's the best framework for clients for this sector? And came up with, ultimately moved it more towards this defensive share category, focused category. And from that point of view, I suppose put in place a smart passive strategy where we have, in turn, across most of these portfolios, have a base index, and then once we apply our ESG and criteria, etc., choose that names from that index on an equally weighted basis. And in many respects, we've been running that for 2 years now. We've made a number of small changes, but broadly, we're really happy with the way the portfolios are performing. Not necessarily in an environment where New Zealand returns and New Zealand shares have been quite muted, but so returns at different points have not been super strong. But certainly, if you look through the returns we've got here, uh, in terms of looking at the different points, returns that have been, I suppose, adequate for the nature of the economic activity, but also ones that sectors that we think are actually really well poised in terms of their opportunity set going forward.
Yeah, and you can even look at that if you see New Zealand property and retirement villages probably caused a bit of the pain this year, but actually they're some of our high conviction positions in the broader New Zealand equity portfolio as well
Yeah.
as the inflation portfolios, because we think just the demographics in New Zealand and globally, but in New Zealand in this case are really strong, and we think we're owning those at a really cheap price at the moment, and these are what 5-7 year hold periods. We think that's really going to come back fast. And
And I think, you look at something like utilities, we've definitely seen electricity prices in the headlines, and you're seeing that reflected in New Zealand utility performance, up 7.5% last year, up 5.5% this year. And again, there's similar story to a degree in terms of global utilities. There's lots of demand for energy. They've had inflation, which has impacted their businesses in terms of cost bases. So they're moving that through the pricing structure and looking to recoup and also position for future growth. And global utilities up 6.7 last year and 8.3 this year. So definitely, those assets have that ability to not only keep up with inflation, but also make sure that there's growth within the portfolio.
and I can see that across a number of these sectors as perhaps also when uncertainty prevails globally, people want to buy more infrastructure like defensive type of assets anyway. And you sort of get that it's not the purpose of these portfolios to be defensive from a geopolitical sense, but actually they perform a lot with a lot less volatility in times of stress.
Yeah, yeah, and that's really is one of the key differences in the growth category. You will have a range of shares there, or predominantly shares, but ones that are not necessarily focused to stable earnings, etc. Might have more volatile earnings, but whereas this sector is quite different. Yeah, there's that stability, which again gives it a degree of people look to buy them during difficult times rather than sort of the heady tech stocks or things like that.
Why don't we touch one or two just to give an insight into how we think about it, and perhaps we stay close to home.
Yeah, I think so. I think that's yeah. Let's start with property and retirement villages. What makes that? I suppose if we go, which again maybe a few too many details in terms of how we construct the portfolio, but the portfolios have a very defined construction methodology, and what we want there is an ability for the asset class to do the work and make sure that uh, in terms of the portfolios that they have across all six different portfolios, we have a very similar selection process. So broadly, the aim is to uh, have a stock selection. If it's in New Zealand, typically we're owning all of the companies in an index, in the sector index. So in the case of New Zealand property and retirement villages, the only real property index we have in New Zealand in terms of listed assets is the S&P NZX real estate index. Uh, from that point, that doesn't include retirement villages. We do think that retirement villages are some of the biggest property owners in New Zealand, so they need to be included in that. That creates some volatility relative to the index. But we have that index. We've got the addition of property and retirement villages, and then we're really setting a couple of tests in terms of how we choose our weight. But broadly, we're looking to equally weight them across the portfolios, and apply our ESG criteria, which doesn't have such a big impact in New Zealand property and retirement villages, but other sectors has a very big impact in terms of excluding assets. And then really a number of small ones. I won't go into them in terms of the smart weighting, where we make sure that with the equal weighting, that we don't end up with a large position in a very small name. So just a couple of tests in terms of size of the asset essentially that we've got. And if we go forward, say, in terms of performance, this is probably one of the more, use a industry term, tracking error is a little larger to the index. The ability of does the portfolio match the index? It has variations from the index. More recently, that has been, you saw a period in second half of last year where the portfolio was much stronger than the index. That was really the retirement villages coming through. This year, that's been a detraction. You've seen certainly Ryman Healthcare look to raise capital again, as that has weighed on that position. However, we still have the view, and again, thinking decades, not years, as a sector, retirement villages have massive demand, relatively limited supply, and you have an ability ultimately to buy that sector at well below replacement cost at this point. So for us, we want clients to have an exposure to that.
And importantly, it's a type of sector that can increase their prices and units with inflation at a minimum.
Well, the benefits from that, right?
Yeah, absolutely.
Exactly. So I think just jumping ahead, something like New Zealand infrastructure. There we've looked at actually, often New Zealand is quite a small selection of names. So New Zealand infrastructure, we're using a wider group here in terms of New Zealand and Australia. But really, looking across, and you can see in terms of target weights, ultimately the weights are relatively similar across the portfolio, and in order to have a nicely diversified portfolio. And if we look at performance there, in terms of the chart, performance over time has been very close to index most of the time. So from that point, again, ultimately doing what it says on the tin. I think I might jump ahead actually a few here to, probably the one that does highlight utilities is probably global utilities is an interesting one. I think that's probably one of the ones which does bring to fore the ESG approach that we do have for good and for bad. So in terms of the benchmark we use there, and we've looked to ultimately find the most appropriate benchmark, what's our starting point, the most appropriate benchmark. And in the case of global utilities, it's the S&P World Sustainability Enhanced Utilities Index. And there we want, as part of our total ESG approach, is making sure that we start from a point where we have the right index. But then we do apply our own ESG overlay, as we do for all positions across all our portfolios, using our partner ISS Ethics. And interesting enough, the aim here is to look at the top 20 eligible stocks in this universe. Of the top 20, even though it starts as a sustainability index, we're only able to own 7 of those names. So it can actually, that can be a real benefit, but equally a challenge at different points in time in terms of which names we own. And so whilst, performance actually has been very strong in this portfolio, it's up about 18% over the last year. You'll see that, for those who've got the chart, actually performance of the index has been far, far stronger, closer to 25% over the last year. Really, that's a reflection that many of those names which we're not able to own in the because of ESG criteria, because they've got coal production or things like that, have actually outperformed in this short period of time. I think you'd definitely find other periods where we'd expect the portfolio to outperform and the index probably to underperform.
The last thing I wanted to touch on, Mark, is for those that are perhaps less familiar with the way that we do and construct portfolios at NZ Funds, is early on your journey into retirement, you get an NZ Funds portfolio, in general terms, would have a lot more growth.
Yes.
And a sprinkling of inflation and income. And as you get towards retirement, growth will slowly start to decrease and you'll increase your inflation. Now, why that's really important is because traditionally with, I guess, frankly, our competitors, in order to de-risk, you'd go from growth straight to income. And this provides that, I guess, swing bridge where you're going into more defensive, less volatile shares, but you still need that growth to, one, I guess, compound your portfolio, because at retirement at 65, touch wood, you've got another 40 years to go,
Yep.
but also mitigates that inflation. And so it really is an important aspect of portfolio construction where you're not going from extremes to high growth, perhaps more volatility, tech companies, those sorts of things, all the way to a New Zealand corporate bond. You've got that in between part, and that's why we call it kind of the swing bridge between growth and income.
Very much so. And I think, again, I don't want to harp onto it too much, but yeah, ultimately your post-tax impact is really important, and that's where the swing bridge is positions it really nicely. So if you think about, you know, even in a pie, 28% tax rate, if you're earning 4% out of cash, or 5% out of 4% out of term deposits, or say 5% out of a bond, 28%, you're broadly, for a bond, still coming back to sort of three and high change in terms of your return. As we saw, inflation at the moment is 2.7% versus, it's been higher. That's the real beauty of, I suppose, being in that swing bridge and having the higher exposure to shares, is that it comes with volatility, without a doubt. We all know shares go up and down, and that can be challenging and maybe not the most comfortable at times. But we do think having a large allocation to defensive shares is a portfolio that will create the best outcomes. Because again, if we think about, say, New Zealand shares and defensive companies that are paying tax and have a high percentage, say 100% fully imputed, if that share does 6 or 7%, you probably expect it to be sort of 7 or ultimately or more over time. You're going to keep that. And that's a big difference versus a number that might be sort of 3%, basically double that return. And really, we think that is that increased volatility is more than offset over a 5 to 10 year time frame by that ability just to generate a higher return. And again, once you move offshore, the the tax regime there, you do pay tax, but it's still a relatively de minimis number. So again, you get maybe not as large a tax wedge that you get to keep versus New Zealand, but you certainly get to keep that.
It's still pretty efficient, and then you wrap that into a pie, and
correct.
It caps it.
Yeah,
Mark, I think that's been a great exploration, should we call it, into the inflation category. I think we wanted to make sure that all our investors and people that are getting to know NZ funds really understand why we've got that category that doesn't really appear in anybody else's portfolio in New Zealand, just in the NZ funds portfolio. Why we think it's incredibly important, often forgotten when inflation's low, and incredibly important when it's high, but also talking about the fact that it's a high conviction in terms of inflation is always something that we should be worried about. But the way that we can, I guess, combat it is be in really good, high quality, diversified defensive shares, and that's a nirvana way to deal with inflation.
Yeah, I think as you rightly said, that sort of provides that nice sort of swing bridge between being ultimately very defensive in cash or bonds, which in a 1 or 2 year period might work out better, but over longer term, and ultimately, even our clients who are retired still have 10-year, 20-year horizons. And in that time frame, your challenge ultimately is the impact of inflation, the compound impact of inflation. And we believe having a portfolio of defensive shares is the best way to look to position yourself to ultimately in 5, 10 or 20 years, make sure that the $100 is still able to buy $100 worth of goods.
And of course, those people in our life cycle in KiwiSaver and Wealth Builder will automatically rebalance every year to get the right percentage of income, inflation, and growth within their portfolios anyway. So there's nothing they need to do. it will happen.
It happens automatically.
Well, we'll leave it there. Thanks everyone for joining us, and look forward to speaking again next time.
Thanks all.
New Zealand Funds Management Limited is the issuer of the NZ Funds Active Income Series, NZ Funds Active Inflation Series and NZ Funds Active Growth Series, together the NZ Funds Active Series, as well as the NZ Funds KiwiSaver Scheme, the NZ Funds Managed Superannuation Service, NZ Funds Wealth Builder and NZ Funds Income Generator. For further information or to request a copy of the product disclosure statement for each of these, please contact NZ Funds or visit nzfunds.co.nz. This recording is provided for information purposes only. The information provided is not intended as a substitute for specific professional advice on investments, financial planning or any other matter. Past performance is not an indication of future returns.